So let's read the product summary for this one. The Target Retirement Income Fund is designed for investors already in retirement. The fund seeks to provide current income and some capital appreciation by investing in Vanguard index funds. This fund's allocations to stocks and bonds is the allocation that all target retirement funds are expected to assume within 7 years after their designated retirement dates. Investors in this fund should be willing to accept modest movement in share price and I'm going to highlight that, modest movement in share price, and be able to tolerate the market risk that comes from the volatility of the stock and bond markets. So that all sounds good, right? So we pick that 2035 fund. It dynamically moves, and that's kind of a more active age-based marketing. Age-based investing. It's going to do it for us, right? It's going to move it over time, and within 7 years of that target date, it's going to go into end up in the Target Retirement Income Fund. It'll be more aggressive until it lands in the Target Retirement Income Fund. Well, this was a great illustration, and I didn't know what this was going to look like, but let me share this with you. So going back to this top fund here, the 2035 fund, which is 70% stocks, 30% bonds. What was the return for 2022? So 2022 was a tough year for a lot of people. Let's see what the return was in 2022. Well, in 2022, the return of the 2035 fund, that's what this is, was negative 16.62%. So if you have $1 million in an IRA in this fund, you're down $160,000. $160,620, I think it would be, right? So let's just call it $160,000. Now, what if you're in retirement and you've got to take out $100,000 to spend that year? Well, you never get the time for that $100,000 that you've now taken out and spent to recover. So that is a permanent loss. So you're digging out of a 16% hole. All right, now you might say, but Mark, this is years away, and we're going to get to the total income retirement fund. And that's where it's more stable, and that's where we're drawing that income from. So maybe you're not being genuine about that. All right, let's look at the return in 2022 of the total income retirement fund that has less risk on the 5-point risk scale. Total retirement income fund, has less risk. It's a risk 2 on the risk scale. And the total return for 2022 was negative 19%. So it lost more than the more air quotes, quote unquote, aggressive 2035 fund. Why is that? Because of the allocation of bonds, and bonds got clobbered last year. So that same $1 million IRA was down about $195,000. So that's worse than $160,000. That's my official CFP opinion. That being down $195,000 is worse than being down $165,000. $160,000. I know I'm being silly there, but this just goes to show you that you've got to be careful what you're doing, because the more conservative, again, air quotes, quote unquote, fund was actually lost more money. Now it's up. I put this here because it's up so far this year. I think as of the 20th of November, yesterday, close of business yesterday, 6.15%. So that might sound good. Well, geez, year to date, it's up 6.15%. You're not even close to, if this was the beginning of 2022, and this is negative 19.53, positive 6% gets you probably not even there, more like here, digging out of this hole. You can still see the bottom of that hole. Hi, Leighton. You can still see the bottom of that hole. You could probably drop down and almost touch it, and so you're not even close to digging out of this hole. And if you had to spend $100,000 out of this portfolio and you're down 19.53%, does that 100,000 ever get a chance to recover? Of course not. The answer is no. So that is an issue with kind of taking the easy road, right? It's like saying, okay, well, I heard this rule of thumb. Just take subtract my age from 100 or 120 if I'm being current, and that's how I should be allocated, and adjust it periodically. And listen, let's be honest. If if you're working with a financial planner, if you're working with a financial advisor or a stockbroker, they should be adjusting that portfolio on a regular basis. But it's likely, even working with a traditional financial advisor, that portfolio is going to stay static. That means it's going to stay the same until there's some kind of outward reason to change it, or unless you request a change. Just because we've seen it. I'm fortunate, folks. I have the opportunity to coach financial advisors all around the country. I was just asked to speak at the Power Zero conference in January in Scottsdale, Arizona. I'm really excited about that and looking forward to that. There'll be 100 or so like-minded, Power Zero-minded individuals, financial advisors in the country, and I have the opportunity to give them my thoughts on things, and I appreciate that. But most portfolios, advisor-driven portfolios or individual portfolios, aren't dynamic that way. They don't adjust on their own. Even something as good sounding and potentially working as this Vanguard structure. You go to the 2035 fund, and it morphs over time to the retirement income fund, target retirement income fund, the Vanguard target retirement income fund. That all sounds great, but it could really whiplash you in retirement, down 19.53% in 2022, something you may not ever be able to recover from, or could have a significant impact on your retirement. And this is one of those critical items that can have a significant impact on your retirement. And, if you knew differently before, you may have made different decisions. But now you know. Now you know, and you can act on these things because I've given you this opportunity through education. So pay attention to these things. Even though the rating is lower, it's 2 on the scale as opposed to 5, the risk scale. Well, it lost just about 3 points, 3% more. And on $1 million, that's $30,000. So that's significant. All right, so how do you address this? Well, folks, the 3 pillars of investing are, say it with me, asset allocation, principal protection, and account segmentation. I think it makes more sense, and I said to this fellow that I was talking to exactly this, so I wrote it down. Where the heck is it? I thought I wrote it down. Oh, yeah. It was, I didn't write down the quote, but this is what I said when he was talking about, well, how should I be invested? I don't know if I'm investing too conservatively. I don't know if I'm investing too aggressively for my age. And I said, risk isn't age-based. It's time-based, and it's needs-based. So the age-based approach doesn't work, in my opinion. Subtract your age from age 100 or 120 and develop your portfolio that way. And the time-based doesn't just work either. Like, not picking on Vanguard, a 2035 fund that eventually morphs into the total retirement income fund or something like it. That doesn't work either. You have to also add in the needs. So age is a consideration in planning, but honestly, it's not really a consideration in investing. The plan drives the investment. The time and the needs identify where that investment allocation should lie. So again, it's not age-based, it's time and needs-based. So look at this here on my screen, and this is the account segmentation I talk about. I'm trying to fit it all on the screen. So you'll see here, and I know these are a little small, but let me blow up one. Use an example. Segment 1. Now, if your clients of ours, you've heard this, S1 referred to as segment 1. Our segment 1 portfolio, you can see, is bonds and money market. We're getting about 5% in this portfolio with 0 risk. And we call it segment 1 because we know that this is to be used during the first roughly 3 years of retirement. So if you're retired in 2023, this would take you to 2023, 2024, 2025, 2026. The importance of that is for the money that you're going to spend now or in the next several years, you want 0 to little risk. Not negative 16%, certainly not negative 19%. Because I use the example of $100,000. If you're in a segmented approach and you need $100,000 and the market's down 19%, is the $100,000 you take out of this first segment going to affect you? No. The answer is no. My 100,000 is here. Sorry, I was blacking it with my picture. The answer is no. And if I needed $100,000 in each one of these segments, then we're covered for the next 3 years. We don't have to worry about market fluctuation or market volatility. It makes sense. And by the way, it works. So how do we get to how do we figure out this number and how much goes in here? If we start with 300,000, and it would actually have to be less than that because we get growth in here. And right now we're getting 5%. Now I rate 5% on there. Our target is 2%. Our target is 2%. We're getting 5% now because we're living in this odd world where short-term interest rates are giving us more return than higher interest rates. And we're going to go a little over, probably past 11 o'clock, just a few minutes, but I'm going to break it down in the different segments or chapters on our recording, but stay with me if you can. Normally this is 2 to 3% in this segment 1, but right now we're getting 5%. So we don't have to quite put $300,000 in there to get $300,000 over 3 years, do we? No. But how do we come up with a $300,000 number? This comes from the financial plan. The investment decisions are driven by your needs. Your needs are identified from your financial plan. It's really that simple. It's not easy, but it is simple. Most people come to us and say, I don't have this. I don't have this financial plan. Therefore, they don't know how they should be investing. They lean on things they've heard, the 4% rule. They lean on my age. How should I be invested on my age? Or they look up something and they say, well, if I just subtract my age from 100 or 120. When in fact, what they should be doing is identify these needs in each one of these segments of time in their life. Because the idea is to get you, I went out too far, to get you to where you're no longer here. You've lived your full life, a happy retirement. You're no longer here. Hopefully you still have some money left in what we call our legacy longevity portfolio. And if I blew out each one of these portfolios, what you'd see is it gets more aggressive as we go out. So the green, if you just take a look at it, the green in these portfolios is stock holdings. So segment 2 is 40% stock, 60% bonds. Segment 3 is 60% stock, 40% bonds. Segment 5 is 80% stock, 20% bonds. Segment 4 is 80% stock, 20% bonds. Segment 5 is 90% stock, 10% bonds. And this all green is what we call our legacy longevity. And that is money you're likely not to need during your lifetime. But if you do, it's available to you. But if you do need it, or if you don't need it, you pass it on to your heirs, whomever you'd like it to be. But you have to identify the dollar amounts that go into each one of these segments. How much do I need during each one of these times, and invest it accordingly? And then it doesn't stop there, folks. These portfolios, usually not this one, but these portfolios all have to cascade down as you use them. And it has to be very dynamic. Sometimes money comes back. Sometimes if we're overfunded here, we might move it down to legacy longevity or even, back into this segment here, but it has to move back and forth. So remember, you've got to identify your dollar needs from financial planning. And that drives how you should be invested and where on that timeline. This is your timeline, right? The line on the bottom, where it fits on your timeline for which segment of your life. That makes the most sense. So forget about age-based investment. Focus on needs-based investing. And of course, there's time in that too, but once you identify your needs clearly in your financial plan, and when you're going, so needs is how much you're going to need and when you're going to need it. And that's the things that you need to do and the things that you want to do. So how much you need, when you're going to need it, the things you want to do, things you need to do, and then you plug in the investments around that. There's a lot of other work that goes into developing the portfolios and monitor the portfolios to make sure that they're the very best that we can be, or they can be. But that makes all the difference in the world. So I think that makes sense. I wrote here, everyone has a different start date. Everyone has different needs. Everyone's got a different financial plan. I think the segmentation and needs-based investing makes a lot more sense than some rule of thumb that somebody made up. Have it be very specialized and specific to you, and that works. And we are within the 11 o'clock. So, folks, I hope that was helpful. If you have questions, you can reach us at questions@attleborowealth.com. That's here, questions@attleborowealth.com. If you want to schedule time with me, if you're not already a client and you want to schedule time with me, you can do so by reaching out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. If you're a client and you need to reach us, pick up the phone or send us an email directly, and we'll get you on the calendar as soon as possible. It is the end of the year, folks. And I've said before that, everybody knows that accountants and tax preparers are terribly busy from, they call it January, but probably February until tax filing deadline. And everybody understands that. Well, folks, this is that time for us. We are extremely busy in our office, and really thankful and happy to be able to be this busy and to be able to do this great work for people and save people just bundles of money over their lifetime by doing tax efficient planning. But be mindful that if it may be a little while before we can get you in the calendar. We do the best we can to squeeze people in. Monday, I'll give you an example. Monday's usually a day that I save for not having appointments, just to be able to prep for the week and catch up on things and do the work that we need to do. And I had 3 appointments yesterday, at least 3, maybe 4. So I'm not complaining. I'm thankful for that. And this is a week of thanks. And I'm thankful for all of our clients, all you folks who are not clients or not yet clients who are listening to this. But I am thankful for you keeping your mind open to things that are maybe different than what you've heard before. I hope it makes sense for you. I hope you implement these strategies and they can make a difference in your retirement plan, because remember, these critical items can have such a huge impact in your retirement plan. And myths and misconceptions, things that you've heard in the past, maybe drove your decisions in the past, that you realize now, if you would have done things differently, you'd be in a different place. But it's not too late to do that. So make these changes in your portfolio potentially if it makes sense for you. Reach out to us with questions you may have. Work towards a tax-efficient strategy. If you have questions about that, we can talk. But I hope you have a great Thanksgiving. I hope you have a great week, and we'll see you next week. If you have any input or questions, things you'd like to hear via webinar, reach out to me, again, at questions@attleborowealth.com. And you can visit our website at attleborowealth.com and download a whole bunch of good stuff, tax forms, other videos, and feel free to share these videos with your friends and family. All right, folks, take care. Have a great week. Happy Thanksgiving.